Hey, Nat.
Hey, Ryan. And hey, everybody. Thanks so much for joining us for this session of the Climate Tech Convening. I'm Nat Cohan, EDF's Senior Vice President for Climate. Thanks so much for joining us today. When we think about where the world needs to be headed to solve the climate crisis, we think about an ultimate goal of net zero emissions. That's the point at which we won't be putting any more climate pollution into the atmosphere than we can take out. So we need to get to net zero in the US and other advanced economies by 2050 at the latest, and soon thereafter in the rest of the world. So how are we going to do that? Well, we know we have lots of the technologies we already need to get started. Wind and solar are cheaper than they ever were before. But we also know that we will need more technologies to get all the way to net zero. So technological innovation, driving down the cost of existing technologies, but also developing entirely new ones, that's going to be critical. And that's what the Climate Tech Convening is all about. Today we'll have the first of 3 sessions focused on zero carbon transportation. Transportation is now the biggest sector in the US emissions pie, and we want to know how we can develop the new innovations that will get us to zero there. Today we've got, for the first of our 3 sessions, we've got Ryan Panchadsaram from Kleiner Perkins to come and tell us about the investing landscape, the current landscape of climate tech investing and what we expect for the future. Those of you who joined us in January in San Francisco will have seen Ryan before, and we asked him to come back and provide an update since so much has changed in the world at large, as well as in the investing landscape since January. A little bit about Ryan. Ryan is advisor to the chairman and an investor at Kleiner Perkins, focused on venture stage companies, where he's been at Kleiner Perkins since 2015. Together with John Doerr, he and Ryan are using every lever they can in the race for zero emissions, but also looking at that from a profit point of view, as well as nonprofit and advocacy. Before joining Kleiner, Ryan was the Deputy Chief Technology Officer in the US government. In 2014, he was featured on the cover of Time magazine as part of the crisis response team that rescued the rollout of healthcare.gov. And after that successful turnaround, he helped launch the US digital service. So given his background in government, as well as his current role in investing, we're really pleased to have Ryan back with us. A couple points on Zoom best practices. After we hear from Ryan, we'll have some time for you to ask questions. We ask you to type your questions for Ryan into the Q&A feature. You can find that feature on the bottom of your screen, and those questions will come to me and then to Ryan. We request as well that you make sure your Zoom name that appears on Zoom includes your first and last name so we know who you are, and it's helpful for follow-up. To change how your name appears, if you need to do that, you can hover over your name in the participant list, click on More, then you should be able to click Rename and type the name you want, the way you want it to appear in there. In a minute, Ryan will share his presentation slides, and you should be seeing those directly, and then we'll come back to Ryan for some Q&A. So thanks so much, Ryan, and over to you.
Awesome. Thank you, Nat. We've got a half an hour together and a lot of ground to cover. And so in January, I gave a presentation on the arc of climate investing. It was a look at the pace, as well as the hard lessons learned and the road ahead. And I'll be honest, things felt pretty good in January, right? EDF got 100 of us together, investors, company builders, researchers, policymakers, and advocates focused on how we advance climate investing, especially on early stage technologies. And at the time, if you remember, if you turned on the news, what did you see? You saw Davos becoming a climate change conference with the largest banks and companies all trying to out-climate each other on the air. Then COVID happened and the world's attention rightfully shifted. So what's happened since then? What was COVID's impact on emissions? What was COVID's impact on clean technology investing at the earliest stage as well as the latest stage? That's what we're going to dig into today. As a reminder, our North Star has been consistent and simple. It's finding and investing in and deploying in zero-emission technologies and doing it at scale, at really, really big scale. COVID shocked our way of life. It halted human activity. We had countrywide shutdowns, flights canceled, factories stopped. It resulted in economies around the globe crashing. It also led to the largest drop of CO2 emissions on record, 1.6 gigatons. It was a drop in emissions, but not one to celebrate. These charts here were produced by a group of global researchers from China and in France and in the US, and they show how each sector's distress mapped to a drop in emissions. In the United States right now, we're living through our third wave of COVID, peak cases, peak hospitalizations. For COVID, we have an exit strategy: tests, masks, quarantining while sick, avoiding crowded spaces, sharing data on where the virus is. And a handful of countries around the world have shown it's possible to beat this virus: New Zealand, Taiwan, Australia, South Korea. In the United States, we're still waiting for a miracle, a vaccine. Unfortunately, there's no vaccine for our emission crisis, no silver bullet. COVID's a warning, and a really clear one. It shows us how bad an exponentially compounding problem can be. And it's what we have to face is our climate crisis is going to be worse. And I'm preaching to the choir here, but collectively we produce over 55 gigatons of CO2 equivalent emissions each year. And our task as innovators and investors is to hone in on those sources of emissions and remove them. We are in the displacement business. This is a flow diagram representing energy flows from Lawrence Livermore. On the left are the energy sources, and on the right, it's how they're being used. While history is rooting for us and our companies, our competition's not. If your business is closer to the left, you're likely a commodity business because you're generating energy, PV, wind, solar. The only way to compete is for you to win on cost and total cost of ownership, either going toe to toe or through an assist or subsidy. If your business is closer to the right, the pink column, you're likely building a product, a new electric vehicle, new foods, deployment of solar, thermostats. You win because you perform better than the alternative, you're faster, you're more convenient, you're more resilient, and often you still have to be cheaper too. Over 10 years ago, on January 7th, 2009, in front of the Senate, my boss John indicated that green technologies would be the next great global industry. He called it the mother of all markets. This economic transformation is underway, and we're still at the beginning of capturing that value, especially if our North Star is zero emissions. Some numbers to convey this opportunity and where we're at. Right now, 60% of installed energy capacity around the globe is still fossil-based. There are 1.2 billion passenger vehicles on the road, and less than 1% of those miles driven are in electric vehicles, only 1%. And the truth is, we know progress is possible. According to Bloomberg NEF, 18% of the miles driven by two-wheelers are electric, and buses are at 30% today. I keep going back to it, mother of all markets. Look at how many batteries we would need to produce if every vehicle sold were an EV. 10,000 gigawatt hours worth each year. And today we only produce 100 today, just 1% of that number. In the world of foods, there's every opportunity to build products and to create products to help people swap and shift away from carbon-intense foods. All these markets are tough. Oil and gasoline. Gasoline is a convenient form of energy, incredibly dense, portable, and cheap. And many beef and dairy products are still really delicious. And there are more markets than these too: concrete, steel, cooling, carbon capture. There's so much opportunity. We know the markets are out there. Now we need the technology breakthroughs, supportive policies, and successful companies. The stages of innovation in clean tech are different. It's worth saying building any kind of company is hard, but the physics that go into scaling them is different. For software companies, as you get more demand, you can provision servers with ease. For marketplace companies like a Lyft, Airbnb, or Postmates, going into new markets requires people, a ground game, recruiting both supply and demand. For clean technologies, things are physically harder. Companies tend to move through 3 different phases. The first is this idea to product phase. Seed to Series B capital is spent on iterating and creating a demonstration that works, possibly even selling at low volumes too. The second phase, you can build or create larger amounts of it, showing there's a path to reduce costs, but likely sometimes not economical yet. So contracts and pricing is hard. And then the final phase, the holy grail. And it's if you're a commodity that's the price you've hit is competitive, or if it's a product that people really, really want, you're able to unlock larger amounts of later stage capital or project financing. Making it through these hurdles is challenging, but with the right teams and technology, it's possible. These are examples of companies valued today or exited at incredible valuations and multiples. At Kleiner, we've been fortunate to be a part of the history of Beyond Meat, Enphase, and Matt Rogers' Nest. Looking across all these companies, none of these stories were ever a straight line. The amount of grit each founders had, the capital they needed to raise, the headwinds they all faced. But when you step back as an investor, these are incredible returns. So how has investing been in 2020, especially during COVID? Doing analysis on this kind of data is tough. So we did our best to filter and analyze Crunch-based deal data. We focused on companies leading the charge towards zero emissions, clean energy, electric vehicles, sustainable materials, new proteins, more efficient agriculture, both early stage and late stage. We looked at financings over 250K. And if we're erring in any direction, it's likely we are undercounting. Over the past 5 years, we've been in a period of urgent optimism. This chart shows cumulative investing by year. You can see in 2016, $6 billion was invested, increasing year over year, reaching a high last year of $13.6 billion. That blue line you see is 2020. You can see we're a little behind our highs from the past 2 years. You'll also see a lull between February and June, very likely because of COVID. But remember, these are announcements of deals. And what you can see is that likely many were still taking place during that time, because you can see that pop in July when they were announced. And so I'm pretty optimistic that we'll end this year higher than in 2018, and maybe we'll get to 2019's peak, because there are quite a few deals that have been completed recently that I think billion was invested across the different financing rounds in clean technologies over the past 5 years. $5 billion was invested across 1,200 seed and Series A deals. $10 billion was invested across almost 300 Series B and Series C deals. 25 was invested across about 177 companies in later stage financings. These were Series D, E, and F and beyond, right? Private equity deals. And then there's this last category here we added called exceptional. And there was a pattern to these group of deals that, made us pull them out, and it makes up about $11 billion worth of deals that appeared to be the exception to the norm. These were 28 deals that were all early stage, right? Between seed, Series A and B, but there were over $100 million. 7 of them were north of 500 million. I think 2 were over north of $1 billion. And these were predominantly EV companies out of Asia. So we kept them separate because it's worth calling out these bold bets on companies at that stage of formation. When it comes to average check size from the past 2 years, clean tech seeds were a little under 2 million, our A's were around 11, our B's 17, and our C's at 87 million. As an industry, our average round size in the A's and B's are less than our technology software counterparts. They were seeing in the past year and two, 15 million as their A's and 32 million as their B's. But for C rounds, though, technology companies were raising less than our C's, right? They were raising around almost 60 million for their average C round versus for clean tech, the 87. And you can see the split where all of this competition is unfolding. 90% of the capital in this space is deployed in the United States and Asia. Most of that 45% is in Asia, is in China. Europe is at 7%. And South America and Africa don't make much of the venture dollars, but you'll find a healthy amount of project financing being deployed there. So where did the big dollars go this past year? This is the $50 million rounds, right? Plus. In Q2, we saw it being invested in agriculture and new protein, in companies like Indigo and Nature's Find. In Q2, we saw it being deployed toward new energy sources like Commonwealth Fusion and improved solid-state batteries from QuantumScape. And when you jump to Q3, Indigo raised additional financing, Perfect Day raised for its dairy protein fermentation technologies, and EVs were on a tear, with Rivian raising $2.5 billion, WM Motors raising 1.4, XPeng Motors raising 500, and ChargePoint for 127. In our current quarter, Q4, Proterra announced a $200 million financing for its electric buses. Plenty, Ripple, V2 Foods are all disrupting foods. I have no doubt a few more will make this list before the end of the year as more announcements are being made. In the world of project financing for new wind and solar, 2020 has been steady. We may not beat last year's 300 billion, but the dollars being deployed this year are going farther because costs are cheaper. We've reached an important crossroad, both politically and economically, where we should be saying no to any new coal and gas. According to Bloomberg NEF, in 2020, both subsidized and unsubsidized renewable energy are already cheaper than new coal and gas fired on a megawatt per hour basis. In the public markets, indexes in particular, clean energy companies have been resilient through COVID. After the collective drop in April, they've powered ahead, even ahead of the technology sector. We've started to pull together a public comp sheet only including truly zero emission companies. There's lots of details here. It's also a work in progress, but we'll make sure to share the video and slides afterwards. But there are some observations, right? Out of the 10 electric only public automakers, well, I should rephrase, there are 10 electric only public automakers, which is an amazing accomplishment. And what's interesting is that half of them went public via a SPAC. And you can see revenue in one of the columns as well too, with little to no revenue for the ones that are public via the SPAC method. For the revenue producers, the multiples are high for EVs, solars and fuel cells, averaging 33 times 2020 earnings. And for the moment, wind is trading with lower multiples at 1.2 times 2020 earnings. And like I said, it's still work in progress, but when we do a refresh, we're going to add in more categories to include the agriculture and alternative protein companies that are public, like the Beyond Meats. Overall, though, these public companies fared well, on average more than doubling since the start of the year. This EDF series is titled The Road to Zero Carbon Transportation, so I can't let you go without at least one slide on where automakers are at with their electric pursuits. This chart here focused on output. Unfortunately, production won't reach 2019's high because of COVID. At the moment, EVs make up 2% of all car sales around the world. In California, Gavin Newsom recently signed an EO with a target of every new car sold to be zero emission by 2035. That's 2 million cars a year. More countries and states need to be setting ambitious goals like these. Globally in output, Tesla is in the lead. This is an American car company. They produced 32% of all EVs this year. Volkswagen, a European company, produced 16%, BYD, a Chinese company, at 10%, and BMW at 9%, another European company. If you're an auto manufacturer and you have not produced at least 50,000 electric vehicles next year, I'd be worried. Tesla, BYD, Volkswagen all had their first 50,000 cars a year milestone 5 years ago. The pace setter Tesla did 389,000 cars shipped last year. These companies are setting a new bar for what competition will look like a decade ahead: battery range and density, charging network speed, and cost. And so let's actually wrap on the year ahead. And we've got a lot of work to do. This talk is US centric, so it's fair for me to say we're ahead in so many ways, in ambition, research, philanthropy, venture capital, but we risk squandering it all. To get to zero, it's going to take all of us, but it's also going to take more ambition, more research, more philanthropy, more capital. And as we debate the scientific merits of climate change in the United States and coddle oil, gas, and coal interests, other countries are plowing ahead. China went bold at the UN, aiming to peak emissions in 2030 and achieve neutrality by 2060, and they'll follow through with their 5-year planning process. I would not be surprised if Asia overtakes North America in dollars invested in the next few years. I would also not be surprised if Europe sets even more ambitious targets than we do here. These are not climate plans. These are all economic plans. Thankfully, learning curves have gotten us to a place where making the emission-free choice is cost competitive and creates jobs, jobs, jobs. But we can't take all this for granted. In closing, I want to bring it back to people. My old boss at the White House, Megan Smith, used to say, people do things. You know, these presentations are full of numbers, stats, and trends, but at the end of the day, people do things. And Moore's Law, PV cost curves, lithium ion cost curves, these curves happen because people invent, we iterate, we invest, we pass policies, and pour our hearts into advancing technology. As investors, we have a pivotal role to play here. Our community continues to get bigger. Since January, I've added funds that announced their launch. or commitment to invest in this space to this slide. And it's amazing to see Amazon and lowercase capital on here. Sorry, lower carbon capital on here. And let's continue to find people doing audacious things and invest in them. And so with that, let's close the year strong. If you have any questions, we're about to jump into that, and thank you.
Great, thanks, Ryan. That was really terrific. So I'll just remind folks, if you're watching, those of you in the audience, please enter your questions into the Q&A function, and they'll get to me and to Ryan. So Ryan, I'm going to start off with the moderator's prerogative here. You covered a lot of ground in that talk. That was super. And I want to zoom in on the area when you were talking about the investments that were made this year and past years in different sectors. We saw a lot of investments in electric vehicles. You mentioned in transport. You touched on some of the others, indigo and ag. Where are the sectors, where are the areas of early stage investments are lagging, where there's more need for funding to go into them? And can you say, is that because the risk differential, the risks are higher, or is that they're untapped opportunities? Where are the areas where there's real a need for investment to go?
I think my easy, simple answer is everywhere, because there's still not enough early stage investing. But maybe if you put EVs as a separate category, there's still not enough across the board, right? We need more shots on goal for creating new batteries, both short and long duration. We need new materials that require less emissions to produce, right? More companies taking a shot at producing steel and cement, and more investment to go in those places as well. And we need more teams trying to crack the nut on carbon capture and sequestration. I think oceans as a whole is a category that's underinvested in, right? These are all places that need more. I think part of maybe another exercise is to actually go through and dig into the 1,200 companies that kind of fit in the seed and Series A category and see where they're starting to break new ground. But I would still say it's probably not enough, and not enough, Nat.
Yeah. Okay. Well, thanks. That's good. That's a good point. So across the board, we need more investment. So let me throw another one at you. I think a lot of folks that have been part of this convening that were back in January, that began in July, that were on the phone, that are on the video now, folks who, some people have a fair amount of background in investing, but are newer to clean tech or to climate tech. And then of course, there are some folks who maybe are already in climate tech, but are really interested in that earlier stage. I'm curious what you would say to folks who are sort of newer to this space. What lessons have you learned? And then in particular on the early stage piece, if folks are looking for more exposure to those early stage companies, what should they look for?
Yeah, I think what's special about this space in particular is actually how open and transparent all of the investors across it are, right? I think we all know that we need each other, right? I think, I had a slide that was just listing the lead investors in all those, 50 million plus rounds. They all have at least 5 to 10 other investors along the ride with them. And so what's special here is there are a lot of investors putting out their learnings, publishing these things very publicly, showing where they're headed, where they think there's opportunities. And that's really special. There's a lot of other places where folks kind of keep that information and knowledge really tight and up close, but you don't always find that here in clean tech investing. I think also the other thing to think about too, the earlier stage you go, you are taking on more risk, right? I mean, this is a very risky, industry to take bets on. And, once technologies are proven, once they've gotten past some of these hurdles, if risk isn't your thing, you can invest in the later stages. But if you are investing on the early side, it's really important to wrap your head around the science, right? The chemistry, the physics, the business models that are going to go along with them. Like there's a lot there. And I think the invitation probably, maybe speak for all of us, it's like having more investors from, not just clean tech funds, but other funds like raising their hand and saying, we're going to spend some time here is helpful too, right? Like this is, an incredible like signaling effort as a whole, but, we don't have to signal too much, right? Because if you look, at one of those earlier slides, it's just the successes of Tesla, Nest, Enphase, Sunrun, and what those founders, Beyond Meat, and what those founders have been able to do. We're all looking at them as role models and trying to follow really, really fast.
Terrific. So I've got a question in from the Q&A function. So you said, I loved your point about it's all about people. People do things, people do learning curves. So given that it is all about people, how do you think, and do you track the benefits of these investments to underserved communities or communities of low-income communities of color that have often been really the most heavily burdened by pollution? And what about the company's commitment to diversity, equity, and inclusion, along with the kind of climate benefits?
It's a great question from Dr. Cook. The tracking of the benefits, I mean, that part is huge. I would say that there's a lack of it, I think, because there's still not enough data being collected on this, right? Like part of this effort to put together this slide deck was going through and looking at Crunchbase data and helping annotate it. There was a lot of different companies that were like, we're a clean tech company. I'm like, no, you're an oil and natural gas company. Nope, let me remove that tag from you. And so I think a part of this is actually for all of us to help annotate this data. It was kind of neat. There's actually a category in the world of Crunchbase for US companies that are, on the diverse and equity inclusion side, saying if it is a founder that comes from an underrepresented group, right, that you can do those things. And so, I'm not trying to like run away from the answer, but Dr. Cook, I think the thing is we all have to start tagging, annotating, and helping each other at least collect the data now, right? Because to do the same kind of exercise for the past 10 years is really hard. The past 5 is a bit easier. The past 2 is a lot easier. But on the piece around equity and it being, for underserved communities, I think that's where cost is so huge. The team from Breakthrough Energy Ventures put out a few pieces on just the green premium that are worth digging into, because you can't get around that, right? Like a lot of these technologies still cost too much, and that premium is real. And depending on where you go in the US and where you go around the world, they've got some really good pieces, and as well on their site as well too, kind of a little interactive thing where you can click on every industry and it's like, oh cool, we're almost there on like energy, and then you click on one over to like transportation, you're like, oh, we've got a while to go on fuels and things like that.
No, that's great. And I think back to our July event that we had for the Climate Tech Convening, and Dawn Lippert of Elemental Accelerator was one of the speakers there. And I know that Elemental is doing a great job really thinking about how to reach some of those underserved communities with its portfolio. So clearly, but as you say, more thinking to be done and more data to be gathered and tracking to be done. So I think probably have one more question, maybe we'll time for 2, depending on how much of a rocket round we do. And that is, how do trade barriers affect the global adoption of new technology, and what will that do to the appetite to invest in new technologies?
It's a great question. I think like we're going to see, I mean, here you have this incredible economic opportunity. Most countries are not standing by. We aren't standing by here either as an investment community, but as like, you think from national strategy and policy, there's reasons why other countries are setting these targets, because for them, they're like, hey, let us get ahead in the world of EVs. Let us get ahead on new sources of energy. And I think the question will be, when it comes to trade policies, like what if the best EVs are produced in Europe and Asia, right? What does that mean for us, right? What if the best sources for wind and solar and new forms come from other places? I think it's going to absolutely influence. I mean, that's why I think all of us here are trying to be as aggressive as we can here stateside. Like I said, this is a US-centric talk with likely folks listening in from other parts of the world. Like this is a competition. We're lucky that, the company in the lead is Tesla. They're an American company, but the broader automotive industry in the United States, they're not in the lead. Most of them haven't even crossed that 50,000, that threshold. And so this will be the center of, I think, a lot of pretty much every trade policy for the next 2 decades, without a doubt. Because energy policy has always been a part of trade, right? So it's like it goes completely hand in hand. And I think another piece there to insert, I think we have to go back to working together with other countries, not like thinking we can like elbow our way and be the only person in the room. Yeah.
No, that's super. Thank you. So I'm gonna wrap it there and just give us a couple of concluding comments. And let me share a couple of takeaways that I took away just really briefly. One is, I love your phrase, urgent optimism. That's a great phrase, and that's where where we are in this space. And the fact that the second point is the fact that we're on track this year, even despite all that's happened, to meet or beat 2018, maybe come close to 2019. That's pretty remarkable. Yeah, fingers crossed. Exactly. And then finally, this point you were just making, I thought it was quite interesting. You said, look, if you look at the year ahead, Asia poised to overtake North America. That's an interesting reminder that capital moves around the world, and it'll move to the best opportunities. And so it's a good thought about how do we encourage the, as you say, not a zero-sum game, but how does some of that innovation remain here in the United States? So Ryan, thanks so much. This was Ryan Panchadsaram joining us from Kleiner Perkins. You were super, really learned a lot. I want to thank everybody as well for attending in the audience. If you have a question that didn't get addressed, feel free to reach out to continue the discussion, continue the dialogue. We'll make sure to answer. The email is climatetech@edf.org, and we'll get back to you as soon as possible. And just a quick reminder, this was the first of 3 sessions on zero carbon transport. The next one on November 17th will be transportation's role in a decarbonized future. We'll look at the science and the policy, a deep dive there. And then on December 2nd, we will have the kind of flagship, the road to zero emissions transportation. We'll be hearing from a range of folks, including a really exciting set of entrepreneurs who are in this space, some of those early stage technologies, to hear what they're seeing and how they're looking at the space. Until then, thanks so much for joining us. And thanks again, Ryan. It was a great session. Take care.